Hey everyone, welcome back to Corporate Decoder, the place where we dissect those dense financial reports and actually make them make sense today. We're diving into MillerKnoll's latest quarterly report, and let's just say things are getting interesting. Make sure you subscribe and join our Discord community, linked in the description, because we're about to untangle a whole lot of numbers that tell a really important story. This is MillerKnoll's quarterly report for the period ending the 30th of August 2025. Think of it as a health check for the company, showing us how they performed in the last 3 months. Let's jump right into the financials. Looking at how much money they made, or in some cases lost, is usually the first place to start. For the 3 months ending the 30th of August 2025, net sales were $955.7 million. That is up from $861.5 million in the same period last year. So, they brought in about $94 million more this quarter. That is a solid 10.9% increase. This looks pretty good on the surface, suggesting more people are buying their furniture and services. Now, out of that sales money, how much did they actually keep after paying for the direct costs of making their products? That is the gross margin. This quarter it was $368.1 million, up from $336.3 million last year. The percentage here is 38.5% compared to 39.0%, so a slight dip. They're remaking more money overall, but it is costing them a bit more to make each dollar of that sale. The report mentions tariff-related costs as a big reason for this small drop. This is the money left over after paying for the cost of sales and all other operating expenses like selling, general, and administrative costs and design and research. For this quarter, operating earnings were $53.5 million, a huge jump from just $15.2 million in the same period last year. This means they got much better at controlling their costs or their sales. Increases really outpaced their expenses. That is a 252% increase, which is pretty dramatic. It suggests they've been working hard to become more efficient. This is the bottom line. After taxes and everything else, the profit attributable to the company as shareholders was $20.2 million. Last year, during the same 3-month period, they actually had a net loss of $1.2 million. So they've gone from losing money to making money. And that is a very important turnaround. This basically tells you how much profit or loss is associated with each share of common stock. This quarter it is $0.29 per S-share, up from a loss of $0.02 per S-share last year. This is a clear sign of improving profitability. Now let's look at their balance sheet. This is like a snapshot of what the company owns, what it owes, and what its owners have invested at a specific point in time. As of the 30th of August 2025, their total assets were $3.94 billion. It is down slightly from $3.95 billion at the end of May 2025. This means their overall value of what they own hasn't changed much. On the other side, their total liabilities, meaning what they owe, are $2.58 billion. This is also down slightly from $2.62 billion, so they owe a bit less than before. This is the part that belongs to the owner's shareholders. It is calculated by taking total assets and subtracting total liabilities. Stockholders' equity is $1.3 billion, up from $1.28 billion. This increase in equity is a good sign, indicating the company's net worth has grown. Let's talk about cash. They had $167.2 million in cash and equivalents at the end of August 2025, down from $193.7 million at the end of May. This drop is not too concerning given their operating activities and investing. This is money owed to them by their customers. It stands at $332.1 million, down from $350.2 million. This decrease could mean they are collecting money from customers faster or have made fewer sales on credit recently. This is how much value they have tied up in goods that are ready to be sold or are in the process of being made. It is $465.8 million, up from $447.5 million. This increase in inventory might mean they are anticipating higher sales, or perhaps have some goods that are not selling as quickly. This line item represents the excess of the purchase price of acquired companies over the fair value of their identifiable net assets. It is $1.16 billion, up slightly from $1.15 billion. This large amount of goodwill can sometimes be a flag for potential future write-downs if the acquired businesses do not perform as expected. Cash flow is king, as they say. This statement shows how cash is moving in and out of the company. This is cash generated from the core business operations. This quarter it was $9.4 million, which is significantly lower than the $21.1 million shown for the same period last year. While net earnings were positive, a lot of that wasn't converted into actual cash this quarter. The report explains this is due to a net increase in working capital, essentially meaning more money is tied up in things like inventory and accounts receivable. Here we see money spent on things like property, equipment, and other long-term assets. They used $30.5 million for investing activities, up from $22.3 million last year. This tells us they are investing more in the business for the future, likely in facilities and equipment, which is generally a good sign for growth. But it also means less cash is available in the short term. This category includes activities like issuing debt, repurchasing stock, and paying dividends. They used $9.2 million for financing activities this quarter. Last year, they used $20.3 million. The big story here is the debt refinancing. They made significant repayments on their term loans, which is a positive step towards managing debt, but they also received proceeds from their credit facility. Overall, their cash balance decreased by $26.5 million this quarter. This is consistent with the investing activities and the changes in working capital. MillerKnoll is a company that designs, makes, and sells furniture. They have a whole portfolio of well-known brands like Herman Miller and Knoll. Their business strategy is really about leveraging the combined strength of these brands. The report is prepared according to you. This is generally accepted accounting principles, or GAAP, and this is for interim financial information, meaning it is not the full annual picture but a snapshot. This note breaks down where their revenue comes from. They have three main reporting segments: North America Contract, International Contract, and Global Retail. Looking at total net sales by product type, workplace products made up $373.6 million, performance seating was $222.1 million, and lifestyle products were $304.1 million. These are the core areas driving their sales. Geographically, the United States is their biggest market, with $694.4 million in net sales. International sales were $261.3 million. The US continues to be the main driver of their revenue. This section is really important. Their intangible assets, especially goodwill, are quite large. Goodwill is sitting at over $1 billion. They had to record a non-cash impairment charge of $30.1 million for their global retail segment and $62.2 million for their Holly Hunt reporting unit. This means the value of those acquired businesses just isn't as high as they thought it was. They also recognized $37.7 million in impairment charges for trade names like Knoll and Muto. This shows that some of the acquisitions and brands are not performing as well as expected, leading to a reduction in their value on the books. Here they discuss how they value certain financial instruments. Their own debt, which is listed as carrying value of $1.35 billion, has a fair value of $1.34 billion. Not a huge difference, which is good. This is their debt situation. Total debt at the end of August 2025 was $1.35 billion. This is slightly up from $1.34 billion in May. They have a syndicated revolving line of credit Term Loan A and Term Loan B. They have $399.7 million borrowed on their revolving credit line. Term Loan B, which has a higher interest rate at 6.5660%, has an outstanding balance of $550 million. They recently amended this loan, extending its maturity to August 2032, and importantly, accounting for this amendment as a debt extinguishment. This led to writing off $7.8 million in unamortized debt issuance costs. Refinancing debt can be good for getting better terms or extending maturities, but it often comes with upfront costs and can impact reported earnings in the short term. At the end of August 2025, they had $313.3 million available under their credit line, down from $382.2 million. This shows they have flexibility for immediate cash need. This section details the costs associated with integrating the Knoll acquisition and other restructuring efforts. For the 3 months ending the 30th of August 2025, they incurred $0.5 million in restructuring charges related to a new 2026 restructuring plan. Last year, for the same period, they had $28.3 million in integration charges related to the Knoll acquisition. The significant reduction in integration charges suggests that the major integration work is largely behind them. This section provides management's perspective on the financial results and business conditions. Net sales increased by 10.9%, driven by higher sales volumes in all segments. Organic sales, which excludes currency effects, also grew by 10.0%. This is positive news, showing that their core business is growing. However, orders for the quarter were down 5.4% to $885.4 million. On an organic basis, it is a 6.2% decrease. This is a bit of a red flag. While they are selling more based on previous orders or their backlog, New demand is softening. This could mean future sales might not grow at the same pace. Their backlog, which represents unfilled orders, is $690.9 million, down 8.9%. This further supports the idea that new order intake is weaker than in the past. Let's look at their adjusted earnings per hair, which is a non-GAAP measure that removes certain time or irregular items. It was $0.45 per S-hair, up 25% from the prior year. This adjusted figure paints a more positive picture of ongoing operational performance, but the decrease in orders is still something to watch. In terms of liquidity, they have $167.2 million in cash and equivalents, and essentially $313.3 million available under their revolving credit line as of August 2025, giving them a healthy total liquidity of about $480.5 million. This indicates they have enough resources to manage their short-term obligations and invest in their business. Now, for my take on all of this, MillerKnoll is clearly making progress in improving its profitability, as seen in the jump in operating earnings and the shift from a net loss to net earnings. The integration of Knoll seems to be largely complete, with integration costs dropping significantly. This is good news as it allows them to focus on core operations. However, the most concerning trend here is the decrease in new orders and backlog. While sales are currently strong, likely from orders placed in previous periods, a sustained drop in incoming orders could signal future revenue challenges. This is a classic case of watching both the top-line sales numbers and the future indicators like new orders. They are managing their debt well, and their liquidity position is solid, which are definite strengths. The goodwill impairment is a reminder that past acquisitions may not always pan out as planned, but it is a non-cash charge, so its immediate impact on operations is limited. Overall, MillerKnoll appears to be navigating a challenging economic environment with improving operational efficiency. The company is financially sound for now with good liquidity and reduced integration costs. The key will be whether they can reverse the trend of declining new orders and maintain sales growth in the coming quarters. Alright, that is our breakdown of MillerKnoll's latest filing. What is your take on these numbers and what they signal for the company? Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.